Hey gang, Chad Ogburn here, your mortgage strategist. What is with all the ruckus about these LLPAs? And is it the end of the world as we know it? Well, today we're going to break it down and find out. All right, let's get right into it. So you have probably seen this. I call it a heat chart. And this is really has been causing quite a stir within the industry and people who are following the industry. And so it's important to understand what this is and what this is not. So this is a comparison between the old loan level pricing adjustments, that's what LLPA stand for, and the new loan level pricing adjustments. This is not the actual loan level pricing adjustments, and that's really important to understand. So let's take an example. This middle part, which seems to really be the one that's causing a lot of angst with people, has a lot of red and a lot of green in it. So what the red means that it is that number in there, so that negative 0.75%, the new loan level pricing adjustments are 0.75% worse than the previous ones. Conversely, at the bottom where it says 640 to 659 for this 80.01% column, is 0.75% better than the old one. It does not mean that somebody with a 740 to 759 credit score in this same column is being charged 0.75 and the person in the 640 to 659 range is getting a 7.75 improvement. That's not what this means. It's simply a comparison from the old to the new. So let's take a look at what the actual loan level pricing adjustments look like. These are the two charts. The one on top is the old one. The one on the bottom is the new one. These are the actual loan level pricing adjustments that created that particular heat map. So what we're going to do today for comparison purposes, we're going to look in this column of 80.01 to 85% loan to value. So people putting just a little bit less than 20% down. And we're going to compare the top tier of the old one and the bottom tier of the old one to their comparable tiers in the new version. So we're going to start with people in the 740. The big change here is that no longer that is the top tier. It goes up two more tiers to 780. So that is a bit of a bummer for sure for those of us who are trying to take good care of our credit. In the old one, you got charged 0.25% to be in this category. Now, from 740 to 759, you're being charged 1 full percent. And I'm going to show you what this looks like in a second. But essentially, if you were to want the same interest rate as without any loan level pricing adjustments, for this adjustment, you would have to pay on the old one, you'd have to pay 0.25% in discount. On the new one, you'd have to pay a full 1% discount. Now, let's look at the bottom tier. So 620, now it's 639 and under. In the old one, they were being charged 3.25%. Pretty darn steep. And some of you might say rightfully so, some of you might not. Now they're being charged 2.875%. So a 3/8 difference between the new and the old. Notice, and this is super important because there's a lot of misinformation about this out there, it is still better to have a good credit score than to not. A good credit score, you are saving 1.875% in discount because you have a 740 instead of a 649. So that's really important to understand. While we might argue the merits of whether this should have been done or not done, it's important to know that it's still better to have a good credit score. It's really important now to meet with your loan officer much earlier in the process so that we can pull credit, see where you're at, and possibly give you suggestions on how to get to that next tier. That's something a good loan officer and his company can do for you. So definitely something to keep in mind. Okay, let's see how this plays out with actual interest rates. So here we go. On the left-hand side, these is a row of interest rates no longer available. This is purely for demonstration purposes. This is not a rate quote. This is how we see rates every day. So how this works is you can see right around the 6.5 to 6.625%, we get to 100.082 at 6.625%. So to help you understand this, 100.000 is what we call par in the industry. And what that means is for every dollar we give a customer for a loan, our investor is going to give us $1 back. If we go down to say 6% and it's basically at 99, what that means is for every dollar we give a customer at 6%, the investor is going to give us 99 cents back. And if we go the other direction, even though it's not on this chart, if we go down to, let's say, 7.25 and we are at 101, that means for every dollar we give a customer at 7.25, the investor is going to give us $1.01 back. So what happens in those two extremes? Well, at 7.25, we would give the customer a lender credit of 1%. Conversely, at 6%, we would have to charge the customer a 1% discount point to get to that interest rate. So that's how it works. But we need to take something else into consideration, and it is loan level pricing adjustments. So let's do that right now. The old adjustment for the 740 just above 80% loan to value was 1/4. So that would mean if the customer didn't want to pay a discount point of 1/4, they would have to raise the interest rate to cover that. So at 6.875, we'd be at 100.302. That 0.302 is enough to cover the 0.25 discount. So that's how that would work. And yes, the difference between those two would be given as a lender credit. Now with the new one, it is quite a bit higher, so we'd be at 1%. Well, unfortunately, the chart I grabbed doesn't even have 7.25, but that's okay. We can imagine just looking from 6.875 to 7, what that difference is in price, and then from 7 to 7.125, what that difference is in price. Most likely at 7.25, we would be right around the 101 spot. So that means from the old to the new would be a difference on this particular day of 3/8 of a point. Now, some days it might be 1/4, some days it could potentially be more, but generally that's about what it's going to cost a 740 borrower to have that new interest rate. Now, if we look at that new level, those new adjustments, and we can see if we can get the client to a 780, now suddenly they're basically in the same spot as the old one. Again, this is why it's so important to get with the loan officer even earlier in the transaction so that we can work with the clients to help maximize their credit score. That is one of the new strategies we're going to have to be looking at. Okay, there's one other thing I want to address, and then we'll let you guys get on with your day. Back to this great heat map here. The other one that seems to be making a bit of a ruckus is this area over here. Now, everybody saw a price improvement regardless of your credit score, but the pricing score, it got even better for people with bad credit. To be honest, it doesn't matter, and here's why it doesn't matter. If you are below a 640 and you are trying to do a 5% down or less on a conventional financing, you're going to have a very difficult time getting an automated approval. And even more important, it's not the right loan for you. It's going to cost you substantially more money. Let's look at why. So we're trying to find the right loan for this person. They're buying a $400,000 purchase house. They're putting 5% down, so they have a $380,000 loan amount. They only have a credit score of 620. If we were to try to force them into conventional financing that they're going to have struggle with getting approval anyway, their interest rate based off whenever I looked at this, again, this is not a rate quote, this is just for demonstrative purposes, would be 7.625%. More importantly, the mortgage insurance on this, which mortgage insurance is something the borrower buys, pays monthly to ensure that should they ever be foreclosed on, the investor will be made whole on their getting their money back. So it's of no benefit to the borrower other than they get to put less than 20% down. $478 a month on a $380,000 loan is huge. 1.51 factor. If you want to learn more about factors, reach out to me. I can go more into detail. That's beyond the scope of this video. That's putting a payment without homeowners insurance and real estate taxes of $3,168 a month. Not the right loan for this person. They're better suited in FHA financing. An FHA loan, based off off the rates when I pulled these, would be at 6.5%. The mortgage insurance is only going to be $158.33 a month, a factor of 0.5 because they're putting 5% down. That gives them a payment, again, without taxes and homeowners insurance of $2,602 a month. Guys, that's a savings of $566 a month. This is why it's so important to get with a lender. If you're in the business, get your clients to a lender early so that they can create the right loan for this person. If you're a borrower, a buyer looking to buy, get with a good, reputable lender who can help you with this. Again, my name's Chad Ogburn, your mortgage strategist. I hope this helped. Reach out, let me know if you liked it or if you'd like any more information. Have a great day, everybody.